In this playlist, I'm going to be breaking down smart money concepts in a very simple and basic way. I'm going to give you a step-by-step guide which will essentially help you learn to trade in 2024. My name is Tom and I've been trading now for over 5 years, and all I've done is find a way to simplify these concepts that you see today. And I do this in a way that a child would understand, because that's exactly how I like to keep things simple and basic. And for me, that is the fastest and most efficient way towards success. I hate the idea of overcomplicating things. All I'm asking for you in return for this playlist that I'm going to be giving to you in the coming weeks is that you like the videos and leave a comment along the way and let me know how you get on in the progress of this as well. Now, if you've been searching on YouTube on how to trade, I can promise you this is going to be the best playlist for you in 2024. If you're looking to learn to trade and you haven't been able to do it yet, then this is definitely going to simplify a lot of things for you. If you're someone that's looking to become a student in our college program, which is an accredited training program helping you learn how to trade, this will obviously give you a nice preview on how I teach and how I deliver in the markets as well. Because all you will actually see on social media, on my smaller form content, is the 1-minute videos. So this could obviously help you with that as well. Now, if you've ever watched ICT, you will see that his information is absolutely amazing and no one can take that away from him. But it is very full on and there is almost too much information on there. My job is to outline the most important parts for you and deliver them in smaller pieces to help keep you engaged, essentially. And this is going to be ideal for you if you're looking for a one-stop shop in learning how to trade. And I would advise that if you are learning to trade with me, whether it be on this free course and YouTube or with our college program or anything else, that you don't mix these videos with other videos you see online. This is because my teaching may be different to someone else's teaching. And I'm not saying for 1 second there aren't other amazing educators out there, because there absolutely are. And I know a lot of educators who teach this in a very efficient way, and I know educators that are teaching a different strategy in trading in a very efficient way as well. But styles make traders, and my format of entering the market might be completely different to someone else's. So all I would say is stick to one provider, one educator, and that way, if you're not watching too many people and you're not diversifying your opinion on different people who are delivering different things in the markets, it's going to stop you from getting more and more confused. And this style of trading is my recipe for success, essentially. And I deliver in this way because this is how, when I was learning, I would have wanted to learn it. And I'm doing it for you in this format, and I'm going to do it in a way that a child would understand it. Because, like I said at the very start, I want to try and keep things as simple as possible. Now, smart money concepts, I'm just going to give you the step-by-step guide. And in this video, I'm going to talk to you about the algorithm. So, firstly, what is the algorithm? The algorithm's main function is to inject liquidity into the markets by adjusting price. The algorithm looks to rebalance price into inefficient areas of the market and then move price towards old highs and old lows, which essentially is liquidity. IPDA stands for Interbank Price Delivery Algorithm, and it's referred to as the algorithm, which is probably a phrase you've heard from ICT. The job is to manipulate price in the market. Now, the trick of understanding that is when you see liquidity being taken towards old highs and lows, there's a lot of people putting orders there. The algorithm is looking to take price to those levels in a way to manipulate the market. And as long as you know that, you're going to be 1 foot or one step ahead of the people that don't know that. And that is going to give you a massive advantage in the markets. So just to go into a little bit more detail, the central banks created IPDA, and essentially they own the money. Now, when I talk about the central banks, I'm talking more actually about the currency. It's more of the currency of that bank essentially created IPDA. So each country will have a main centralized bank, USA, Bank of Australia, and England, and that kind of thing. And essentially, they are the ones who own the money. They move the money around in the market. And retail money is liquidity. Now, we are retail traders. We don't have the capital to compete with the size of capital that IPTA is moving around in the market. About $5.5 trillion worth of liquidity is moved around on Forex alone on a daily basis. So unless you've got massive pockets, which a lot of us don't, essentially you have to get used to the idea that we are retail. Now, there is a difference between retail trading methods and smart money concepts methods in a way which I'm going to explain to you the more this playlist goes on. And our job is to ride the coattails of IPTA. And again, I'm going to divulge more onto that and explain what I mean about that, basically just by showing you in video format. IPTA utilizes data ranges based on a period of time, 20 days, 40 days, and 60 days. I'll show you what I mean in a minute, but essentially, you look back 20 days for highs and lows. If those highs and lows have been taken, you then look back for 40 days and then so on for 60 days. But once again, I will show you when we come onto the charts. So, delivery of price to buyers and sellers in the marketplace by doing two things. What I'm going to do, I'm going to take you to a chart and I'm just going to basically explain to you what that is. So this is a chart, and what you see here obviously are candlesticks. Now, the idea is that the two things happening in the market is that price is rebalancing into inefficient areas. And I am going to explain imbalances in a separate video. But essentially, price will rebalance into areas and seek towards areas of liquidity in the form of old highs or old lows. As you can see here, new highs are being formed. Price is retracing back into areas of inefficient price action, seeking towards areas of liquidity. On its route towards areas of liquidity, you can see price rebalancing into this gap created in the market right here with these two wicks. Once price has swept into these levels right here, you can see price searching and seeking to destroy liquidity in the market, i.e. old highs and old lows. So when you look at price here, we're now on this retracement back down into a key level. You would assume that price is heading towards this liquidity here, meaning you would be looking for price to go higher in this example. If you go to a smaller time frame, you'll see things on a little bit of a different level. You can see that price has dropped lower. And once price has dropped lower, it did that after seeking or coming out of this high here. When you look at this level here, price is starting to drop a little bit lower. And basically the idea is that price is going to react inside areas of imbalance and from levels such as this one here, which is going to be your order block, which again, I'm going to explain to you in more detail. You can see here price is seeking towards this liquidity here. Once this essentially has happened in the marketplace, we would expect price to start turning around. This is a low in price action. Once the low has been taken out, you would then expect price action to come back into these levels and either carry on marching towards these levels of liquidity or offer us a reversal in the market, maybe towards this high right here, or maybe even towards this high right here. If it was to do that, and it was to start a reversal, you should notice a massive gap in price right here. That is an area of inefficient price action. As you can see, price action expanded heavily to the upside. When price action expanded to the upside, it left this gap. And price is inefficient in terms of sellers because this is what we call buy-side imbalance. The reason that is buy-side imbalance only is because there are only buyers in the market. But that is inefficient to sellers. So sellers are driving price back down to rebalance into this level right here. So I would be looking at this thinking, once we've swept below this low, which is liquidity, Are we then going to trigger a reversal to then take price towards this high, which is liquidity, and this high, which is liquidity? And another little tip for you as well, when you see liquidity in the form of relative equal highs, that is more of a strength that there is going to be liquidity there, because buyers and sellers are placing orders in the market here, leaving money on the table, i.e. more liquidity, which is going to be a magnet for price. Okay, so basically we're looking to utilize these levels. And if I go down to the chart on a smaller level and just kind of delete everything here, just kind of looking at what goes on, you can see in this example right here, we came into this imbalance and we came down towards this liquidity right here. You can see that price action created another area of inefficient price action here. Price jumped into this level and dumped to the downside. You can also notice that price did that by coming above these highs right here. That is the manipulation phase I spoke to you about in the market. Price will manipulate higher to then come lower, and vice versa. Price may go lower to then go higher. And that's the sort of thing we're going to work on in the next couple of weeks on this playlist. Now, I spoke to you essentially about data ranges, and all that is, if you imagine a chart here, for example, let's say you had some form of liquidity that was taken out. If you can just imagine splitting your chart, let's say price action is here right now. Let's go backwards in time 20 days, just randomly here. So that there is going to be 20 days. If you look at old highs and lows and you can see that we've started to reverse, you can see that price has already taken out that low, you would then expand it towards 40 days. And basically what you're looking for is a target for this data range to search towards. So you could see that price is bearish. Price will look to seek liquidity within a 40-day period. So basically, when we've swept under this low here, and we haven't got any more lows we can see, but we're still bearish, we're still creating areas of inefficiency, you would then move it along even further, and you would be looking for a range within 60 days. And within that 60-day period, if you see lows that are likely to be targeted, you can do that on the understanding that these data ranges are in place. And then when you see price reversing, you can look back 20 days from the period and you can shift it all along, and you can see, is there a high there that could potentially be taken within that 20-day period? And that is going to show you what IPTA is looking to try and achieve. So hopefully you've found this video insightful, and what I'm going to do, I'm going to probably do every couple of days, or at least in a minimum weekly, I'm going to upload more videos for you guys, giving you more of an understanding of the way of these concepts and basically just helping simplify the whole thing. So guys, with that, I will see you on the next one.